Hello and welcome to a quick vlog from me, David Jones and Trading 212 on trading strategy. And what we're going to cover this time around is money management. It's a really important part of trading, and I think it's one that plenty of people ignore, where they'd rather go off and look at lots of different indicators and support and resistance and trends, and don't focus on this really important aspect. And it's basically how much do you risk on each individual trade. So it's not about where to set your stop loss, but it's how big or how small your trades should be. So there are a few ideas on this that can really, I think, help you stack the odds in your favor and also take some of the stress out of trading, where you're not worrying about every tiny 1-2 point move in the market. So let's go through some ideas on money management. Let's just run through some numbers first, just to show why this is important. To keep the maths easy for me in my head, I'll stick to round numbers. But let's say you start off with an account with £5,000, 5,000 euros in, $5,000, whatever it is. And you decide that on every trade you do, you're going to risk losing 10% of that account. So your risk on every trade is going to be €500, £500, $500. That's your risk. Now let's say you have a bad run, which is perfectly possible, and you have 5 losing trades on the trot. So 5 losing trades after each other. You're risking losing £500 on each trade. So your account has gone down to 2,500. So you're now in a position where you need to have 100% return. You need to double your account just to get back to where you started. This is an incredibly demoralizing position to be in. Chances are you'll either start taking trades that are too risky, that don't fit your strategy, or because of the run of losses, because you've lost half the money, you'll be afraid to take perfectly good trades according to your strategy. So clearly something is wrong with the amount of money that we're risking. So let's take a couple of steps back. Now, most sensible approaches to risk management suggest that you should only risk losing something like 1 to 3% of your account on any one trading idea. So for example, let's go back to our £5,000 account. If I decide to risk losing 3% on any trade, what it means is if any trade goes wrong, it should only lose me £150 in this example, because that's 3% of my account. So when I'm doing a trade, I decide whether I'm going to buy, whether I'm going to sell. Then I look at where my stop loss is. So I work all that out, and maybe I'm using the chart or some other method. But then I trade in a size that means I'm only going to lose £150 in this example if the trade goes wrong. So let's again walk through a theoretical example here. So here is by now our familiar theoretical market. So the market we think it's hit a level of support at 110. The market's currently trading at 115. So we're thinking about being a buyer here, and we're going to put our stop loss at 100. Now you remember, for the purposes of this, I'm saying I've got £5,000 in my account. I only want to risk 3% on any one trade. That means £150 risk on any trade. So if I'm buying at 115 with a stop at 100, then my risk is clearly 15 points. So my money management approach tells me I need to trade no bigger than a size where each point move is worth £10 to me. Because if I get stopped out, if I buy at 115 and get stopped at 100, I lose 15 points times £10 a point, £150, which is within my risk parameters. And it's another one of these things where instead of spending time worrying about Bollinger Bands, MACDs, moving averages, stochastics, most people don't think about this side of it. Just the financial risk management side. And if you're trading at a level that's 3% or even less, then you can have a much calmer approach to your trading. A run of losses isn't going to do massive damage to your account. And it means, I think, you can look at the markets in a disciplined and calm manner. Hopefully there's some ideas there that you'll find useful and be able to put into practice with your own trading. I can't stress enough just how important it is to sit down, think about the size of your account and give some consideration about how much you're willing to risk on any one trade. Because the reality is, most people, particularly in the beginning, end up risking too much. And if you're risking a chunk of your account and you have a run of losers, even a small run of losers, it can really do some damage. So hopefully there's some ideas in there for you to try out and think about when it comes to your own trading. We'll wrap things up there. As usual, if you're not subscribed, you can click the button there to subscribe and get notified when these videos come out. If you'd like to leave us a message about stuff to cover in the future or any questions you've got, then just leave it in the comments down below. And if you like the video, just click the thumbs up. But we'll leave things there. I hope you have a good trading week, and we'll come back with another strategy session in a week's time.